The following program sponsored by Adams Financial Concepts.
About money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth, and has a proven track record of managing long-term investments surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
It is Thursday. We're going to be talking about money. And if you're listening to this program on Friday, it's Friday. If you're listening to it on Saturday, it's Saturday. We do this program, it's 3 times. So just stay tuned. We've got a lot to cover today. I don't know if you were listening to the news at the beginning of the program, but it was announced that somebody is building a plant. It's going to employ 500 new jobs. Do you find that a little strange? I found that a little bit strange. Last month, we added a net 242,000 jobs. 242,000 jobs. That's an average of 8,000 jobs per day. And here we talk, and building a plant to add 500 jobs makes news. I find that a little strange, but then maybe that's just my mathematical background coming into play. And when we talk about 242,000 new jobs added, that's net. That's not total jobs of people changing. That's net. 500 jobs, nothing wrong with creating 500 jobs, but in the grand scope of things, it's a pretty small amount. So this is the season. You know, it's the holiday season. Kids are gearing up. We have Santa Claus. And if you go down to the stores downtown, there's Santa Claus, kids climbing on to Santa's lap, asking for toys or goodies or whatever they might be asking for. And you know, you the listener, you know that Santa Claus is a myth. Well, you know, some of the same kind of myths exist in the financial market. People state things that are only partly true. They're a real, in my opinion, myth. It's important to understand the total. We're going to get to that late in the program today. That's coming. We're going to talk about maybe 1 or 2 myths. Important to understand how they come together, and important when you're looking at your own portfolio. You know, I have a great guest today. You want to hear what he has to say? That's coming later in the program too. But remember back at the time of the dot-com bust, maybe the year 2000, 2001, there was somebody that had a bumper sticker that said, "Please God, just one more bubble." I always found that a humorous bumper sticker. Well, we're going to be talking about that today because we exist right now in a bubble. We're going to be talking about that bubble. Some of the classic books. If someone asks me, what are the best 6 books you can read about in terms of investments and marketing, I think there's some, well, at least 5 of the 6 I want to mention today. You know, Peter Lynch's book, One Up on Wall Street, it survived the times. It survived. It's now 30 years past the time when it was written, and it's still trustworthy and valid today. The same is true of John Train's book, The Money Masters, talking about money managers who achieved results which are extraordinary. You know, when I first got into the business, I didn't know if there were hundreds or thousands of people that outperformed the market, or if there was no one. There were very few that actually did much better than the market. And John Train wrote biographies of several of them. It's worth reading that book. Charles Kindleberger wrote a book that I read at the end of the 1980s, the beginning of 90s. It was called Manias, Panics, and Crashes. Became a very popular book to read in about 2008, but it outlines what's gone on since the 1600s with manias and panics and crashes, and what the underlying reasons are that we have the manias, when we have the panics, when we have these crashes, is really a valid book and really lets you understand what went on in 2008, 2009, and where we are today in respect with that. Robert Hagstrom wrote the book, The Warren Buffett Way. I found a lot of great information out of that one as well. But the one I want to talk to today was actually written in 1841. 1841. Charles Mackay wrote a book called Extraordinary Popular Delusions and Other Madness of the Crowd. And he talked about a number of times in what we call bubbles. The South Sea Bubble. In 1711, John Blunt got an exclusive trading rights to trade everything in South America. He was granted those by Britain, and not only was he granted those rights, it was financed by the British government. They took on a debt, a country debt of 10 million pounds. And Blunt put out stock to the government. And by 1719, you had enough trade going on that there was more financing. And this time, they did a very complicated arrangement with government debt and stock that was sold to private individuals. And by 1720, rumors started about how wonderful this was going to be, and the stock in the South Sea blew up tenfold. It went from 1,000 to 10,000 in 1 year. Similar scheme generated by John Law in France. It was called the Mississippi Scheme because he was given the right to trade in Mississippi. You remember that the United States purchased from France the Louisiana Purchase, which was a lot of the Midwest, from Louisiana all the way up north. John Law was the person who brought the idea of paper currency to France. And along with that, he got the rights to Mississippi. And at one time, somebody paid a person, a hunchback, paid them the equivalent of $250,000 today for someone to use his back to sign a stock certificate. Can you imagine that? Tulip Mania is probably the most talked about ancient bubble. And it started in the 1600s. There were some tulip bulbs that were brought from the Ottoman Empire. It was a luxury item and very highly desirable. But prices began to increase, and speculators began to speculate in tulip bulbs. Tulip bulbs, think about it. They're perishable. But by 1635, the price of a tulip bulb had risen so much that 40 bulbs sold for 100,000 florins. What that means? The average annual wage for a person living in Holland at that time was 150 florins. So one bulb sold for a price that a normal worker would spend his entire amount of earnings for 16 2/3 years to buy one tulip bulb. 40 bulbs could be traded for 1,000 tons of butter. Not 1,000 pounds, 1,000 tons of butter. 40 tulip bulbs could be traded for 3,000 fatted sheep, mature sheep, 3,000. 40 bulbs could be traded for 2,500 oxen. You know, by 1636, you could trade 2 bulbs for 12 acres of land. And it made a number of people in Holland very rich. There was a story, a true story, about a sailor who didn't know about the tulip bulbs, was invited to dinner by a merchant in Amsterdam, or either Amsterdam or Rotterdam. I don't remember the place. But he came and he saw this bulb sitting on the table. He thought it was an onion. And he took a couple bites out of the bulb. He was arrested. And very close to being executed for taking a couple bites out of a tulip bulb. You know, the fact is, by February of 1637, there were no more buyers and prices began to drop. And you know that today, tulip bulbs are pretty cheap. But that was Tulip Mania. Today, I think we're dealing with another bubble. We've gone through the dot-com time. Remember the dot-com time? People believed that brick and mortar stores were going to completely disappear. It was all going to be the information highway. Everything was going to be sold on the internet. You had numerous companies that wrote a 3-page business plan and raised millions of dollars on a 3-page business plan. There was a machine shop that came public. What they did is they put the name of the machine shop, put .com after the name, and it came public at probably 7 or 8 times the real value. That was the .com time. People talked not about earnings or about sales. They talked about real estate. Not real estate like we think of it, but real estate as how much of the computer screen they controlled. They talked about the number of page hits that a company had. Nothing about the sales and the profits or what they generated. You know, if you look at the internet today, and we'll come back to this right after the commercial break, so don't go away. We've got more to talk about today's current bubble.
About Money with Mike Adams will resume in a moment on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Did you know the 20-year annualized S&P return was 8.19%, while the 20-year annualized return for the average equity mutual fund investor was just 4.67%? That's a gap of 3.52%. It doesn't sound like much now, but it could mean the difference between retiring in comfort and running out of money. For some seniors, a gap that large could cost them hundreds of thousands of dollars and cut their retirement short. Don't run out of money. Call Mike Adams of Adams Financial Concepts today, 206-903-1019, and learn more about how you can, 1, create wealth for retirement, and 2, protect yourself from running out of money. Adams Financial Concepts specializes in creating and maintaining wealth. Call today, 206-903-1019, or log on to adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.
Products they offer.
We're back with more About Money. For details on what you hear on today's show, visit adamsfinancialconcepts.com. Now, here again is Mike Adams.
So, I'm coming back. I've been talking about bubbles, and I ended talking about the dot-com bubble. Now, I remember it was toward the end of 1998, maybe the beginning of 99. I was at the grocery store, and in front of me were 2 young women. I think they were in their 20s, thereabouts. And one woman was saying to the other, "You've just got to buy stocks. You know, you can borrow money on your Visa card, and you'll only have to pay 18% interest." And I knew at that point the bubble was coming to an end. You know, it probably lasted another 15 or 18 months, but that kind of feeling that, you know, you just can borrow on your Visa card, pay 18% and make so much money with stocks. That's the end of a bubble. That's truly the end of a bubble. And so it was. 5 or 6 weeks ago, a former sales assistant called me in the office. "How are you? How are you doing?" We had changed a little information for a while. And then she said to me, "Could I borrow $10,000? I said, "For why?" She said, "I want to buy a Bitcoin." Now, this is a person who has no investment knowledge, or very, very little, and wants to buy a Bitcoin. And I thought back to that time I was standing in the grocery store line listening to one woman explain to the other, "You got to buy stocks. You can borrow money on your Visa card." Here was a person that wanted to buy Bitcoins. Now, the reality is, if she found somebody that would have loaned her the money, and I didn't, she'd found somebody to loan her the money and she sold out, bought it then and sold out today, she'd made a lot of money. But the fact is, bubbles keep going and no one knows when they're going to end. But they are going to end. Bitcoin has skyrocketed 1,600% in the last 18 months or so. That's 16-fold. $10,000 would have grown to $160,000. That's really great on the way up, but things come down much faster than they go up. When they run out of buyers, things begin to collapse. Is Bitcoin a really good deal? A bad deal? How do you evaluate? I've been in this business for a long time. I do stocks, I do bonds. When you look at a stock, you have earnings, you have sales, you have product, you have something to look at and value and say, what should the price of this stock be? If you looked at the company, what's the value of this company? What should the price be worth? You're buying an ownership position in a company. If you're buying a bond, you're looking at the credit quality of the issuer of the bond, and you're getting paid an interest rate. And you can say, am I getting paid enough for the credit of whoever issues that? There's something to evaluate it. But a Bitcoin, how do you value it? I've heard people talk now that it's going to become a currency for doing worldwide trade. Well, let me give you a little example of or give you some background on why we use the dollar as trade. Going prior to 1914, there were three primary currencies: the English pound, the French franc, and the German mark. But coming out of the Great Depression and out of World War II, there was a meeting in Bretton Woods. The United States had a large trade surplus at that time. UK was a big debtor nation. The UK sent John Maynard Keynes. US sent Harry Dexter. France, Japan, and Germany all sent representatives. And they began to talk about the rules for currency exchange. And it was settled on the dollar. Today, 85% of all foreign currency transactions are done in dollars. Over 60% of all foreign countries carry their reserves in dollars. The dollar is the world currency because, number one, the sheer size of dollar-denominated debt instruments. There's low spreads between the bid and the ask, and there's a large volume of trading. The dollar trades 24 hours a day, 7 days a week, 365 days a year, even holidays. The dollar is traded. The dollar is considered a safe haven. When you had Arab Spring, those countries went to dollars. When you have the tsunami in Japan, they go to dollars. The dollar is the safe haven. And that it was especially true even when you look at the Great Recession, when Lehman Brothers went down. People retreated to dollars. And the United States is a very stable country. If you look at other stable countries in the world, their currencies aren't big enough for large transactions. You look at Switzerland, it's a very small country, doesn't have the reach that the U.S. has. And the United States unconditionally backs the U.S. bonds. We haven't defaulted. There's an intent not to default. Currencies are traded, just like the Bitcoin is traded. Currencies are traded, but the Bitcoin is very, very small in relationship to the dollar, to the franc, the Swiss franc, to the euro, even to the Chinese currencies. It's a very limited amount. So you can make an allegory or an illustration. What happens to a currency or what happens to a stock when you have a very limited supply? You know, when you have a very limited supply, the price can be driven up very rapidly and very driven down even more rapidly. With the Bitcoin, I truly believe we're in a bubble, and that what will happen is when the bubble bursts It's like a regular balloon. You blow up a balloon, you blow and you blow and you blow. If I finally get the balloon to its normal size, you put a pin into that balloon, it deflates a lot faster than when you blew it up. Bubbles, we're seeing some of those bubbles, and we live in a time in which we're seeing more. We saw the dot-com bubble. We saw the housing bubble. We saw a bubble in gold. We're seeing a bubble now in Bitcoin. People are looking for a thing of get rich quick. Fact is, wealth is built slowly over time. It's amazing that if you look at returns over 25 years, that you can turn $100,000 at a 20% return into $10 million over 25 years at 20%. You can turn it into 100,000 into 3.3 million at 15%. You can turn 100,000 into $1 million over 25 years at 10. But when you're trying to turn 100,000 into $1 million in 12 months, the chances are you're going to lose a good portion of your 100,000. You know, for me, it makes sense to look at things where you know the value is, where you know if you hang on, you're going to reach your goals, not to try to become overnight wealthy, because most people that try to do that become overnight poor. Anyway, the bumper sticker said, "Please God, just one more bubble." That has been granted. Here we are. I want to introduce my guest today. My guest is Chris Johnson, the CEO and founder of iTelis. So welcome to the program, Chris.
Thank you.
So why don't we start with your background?
So I'm the CEO and founder of iTelis.
But before we got to iTelis, let's talk about what you were doing before then.
Oh, sure. So I graduated from Miami University with a degree in applied science and systems analysis, and started working for companies like Accenture and Bearing Point for about 15 years as a development and delivery consultant. Now, after that, I started focusing on business development in terms of working with clients to define projects as opposed to delivering them here in the Pacific Northwest. Now, following that work effort, I was for a company called Solutions IQ, which was more of a boutique, very focused, agile principled company. I founded a company now known as Dev9 and ultimately now iTelis. And what I've been trying to accomplish is to bring the large-scale disciplines that I experienced working for large programs with companies like Andersen Consulting, now Accenture, to smaller companies that are boutique and very value-driven, very focused, so that they can scale and smaller companies, mid-sized companies, can take advantage of the same quality of service delivered by the larger companies.
Okay, so this is primarily a software business then?
Yes, it is. Yes, it's primarily a software development business, but it's also a consulting business. And so in terms of developing software, we think we're pretty good at it. And there are clients who want to take advantage of our development skills, and then there are also clients who want to take advantage of the way that we develop software from a consulting standpoint so that they can bring those same skills into their development shops.
So I want to drill down on some of these as we talk about this. If you were to divide your business into several different segments, because you talked about two, if you were to divide it into several different segments, what would you call the segments?
From a delivery capability or from an industry standpoint?
From just a general.
So we do custom software development. We do systems integration, which is building workflows across the systems that have been developed or the custom or commercial off-the-shelf software that clients purchase. And then, of course, we do the consulting that I was referring to earlier. So those are the three things that iTelis does: custom software, systems integration, and management consulting.
So if I were to come to you and say, I have a project, you'll build a software program for me?
Well, if you came and said, I have a project, the very first thing we're going to do, very similar to what you said during your discussion around the bubble, is we're going to find out where the value is in the software that you've asked us to build.
Okay, hold that thought. We're going to come back right after the commercial break.
Sure.
First, the commercial.
More About Money coming up with Mike Adams on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.
Now we return to About Money. There's more information waiting for you at adamsfinancialconcepts.com. Here again is your host, Mike Adams.
So I'm here with Chris Johnson of iTrellis. We just got started on talking about what iTrellis does. So let's go back to that. Give us a picture, the large 1 mile view of where you are at iTrellis.
Okay, so what you were asking before was a client comes and says, I've got a project that I'd like some help with. And there are different levels of engagement that we typically respond with depending on where they're at. Now, our engagement flow ranges from assess, pilot, build, operate, and transfer from beginning to end.
So let's start with assess because that's the beginning. So what does that involve?
Well, oftentimes clients either have an existing architecture that they want us to help with, or they have nothing and they're looking for recommendations.
So when you say architecture, what do you mean?
That's the technology framework that the solution that we're going to build for them is constructed on. So examples of architecture that people are pretty familiar with in the cloud space would be AWS or Microsoft Azure. Those are deployment frameworks that people can put their software into and then have generally accessible. So from an assessment standpoint, it's important to understand what needs to get built, almost as much as important as where you're going to put it, and when do we need it, and what the scope and scale of it is. And that's what we do during the assessment, as well as if they want us to join their team, how they're building things and how we would recommend changing the way they build it or just joining in with them.
So as I hear what you're saying, it seems to me like it's the company that's got a marketing program, they've got an accounting program, they've got all these different things that are working together, and they suddenly realize nothing's really working the way it should.
Right. That happens a lot. And that's more a case of the systems integration work that we do, the second tier of the company. And it's cases where you have different departments that have individual solutions, and there's sort of a cultural understanding of how work should flow across those departments. And what a lot of companies are doing is they're taking advantage of the internet and they're taking advantage of the rapid development tools that are out there in order to construct workflows that cut across these departments and move data faster, make the company more efficient, and provide better services in the marketplace. That's systems integration.
So you mentioned pilot. So once you get beyond the assessment, you begin to look about. When you say pilot, I'm assuming this is really beginning to lay out the framework of where you're going.
That's exactly right. So what we want to do in the pilot phase is take a small set of the total value that they're asking to have constructed, and we want to build it from end to end. Now, in a typical user-centric commercial software offering like the web as a starting point, there's a user interface that people are connecting with. But behind the scenes, there's network connectivity, there's all sorts of back-end servers that you're hitting, and somehow that data needs to be packaged up that you're looking for and brought back and presented to the user. That's the architecture that we need to prove out in order to demonstrate that, yes, in fact, we've got the right architecture, and in the process of constructing that small portion of the total project, we provide the basis for estimation as to what the total cost will be, which brings us to the build phase.
And the build phase?
The build phase is where we have determined that we know how we want to build it in conjunction with our client. We know the total scope, we hope, of what they want built, and we can come back to that in a minute. We practice continuous delivery principles, so we allow for flexibility in the construction. You know, the way you start a project isn't always the way you end a project. Kind of like modeling a house.
Yeah, it takes a few right and left turns.
Right, and sometimes you discover you need something that you didn't think you did when you started, or you realize you don't need something that you thought you needed. But at some point you have to agree to a scope. And we practice several techniques that allow us to flexibly construct the entire solution over time. If we know what our plan is in terms of a roadmap, and we have a team that understands how to build those things in the architecture, the last thing that's remaining is a process by which the team works together. And I think one of the things that iTrellis does really, really well is we view software development as a team sport. We have people who know where their role begins and ends, and they work together to accomplish the entire solution. So from the point of assessment, we figure out what it is that is of value. The pilot is a proof that we know how to build it, and we can estimate it and plan it. And the build phase is the construction, which tends to make our clients very happy.
And is that the end of that's not the end of the process, however?
No, not at all. In terms of our client engagements, as we start with assessments, it's more of a consultative feel. As we move into the pilot, it starts to become more of a consulting delivery engagement. As we move into the build, oftentimes we blend the staff that we put forward with some individuals who might be inclined to join the client on a contract to hire basis. But after we've built the core solution, you might consider it version 1.0, we need to move into a sustainment phase. And a lot of our clients are putting their software into the cloud, or they're bringing their solution in a split fashion of traditional on-premise server solution delivery and cloud solution delivery. And so in that situation, we have to work with our clients to transition the solution to them. And and we support them in a sustainment model, either in the cloud or on-prem, to make sure that the solution's working and that they can take responsibility for it. Longer term, if they can't, we introduce them to some of our partners, like Atmosera, a cloud service provider based in Portland, who can take responsibility for long-term sustainment and maintenance. But ultimately, at the end of our project, we need to go away. And that's the transition phase where we document and make sure that all of their team members are trained.
So I have a question. I want to go back, and I've been waiting to ask the question until we got through the whole process.
Yeah.
So when you go and begin the process of building, you have people who must have specializations. So do you bring in new people to do that? Do you hire people? If I come to you with a problem, will you have people that can address that problem, or do you need to hire people to do that?
So it's a combination of both. We have a fantastic set of consultants on staff, and then we oftentimes hire people with niche specialty skills depending on client need. But the people that we hire are what you refer to as full stack developers, and many of them are multilingual and multi-platform. And what I mean by that is that, much like you were describing in terms of Tulip Mania, there's always something better in technology. There's always something new, bright, and shiny. And so over time, our consultants have worked in a wide variety of solution areas. They've worked with a wide variety of tools and development languages. And for the most part, most of our projects come down to C#, Java, kind of tried and true languages, coupled with other languages that are more contemporary and more focused, like Go, things that are on the front end like React. These are all technologies but they have similar roots. And so every client situation is different, but we tend to find patterns for development across all of our clients. And so we have a core of people who are really, really good at software engineering. And then we supplement those people with some niche skills that we may need for something very specific, like a manufacturing process that requires a very specific knowledge of a European specification for communication.
So it's not trying to fit a square peg into a round hole. You're actually bringing in the expertise that's needed.
Yes.
Whether it's with you now or whether it's consultant or whether it's a third party.
Right. And that's where the value of the pilot comes in, because we need to be able to prove that we can do it. There are a lot of failed efforts that went through a long planning cycle and a long architectural cycle, and then they think they're all set and ready to go, but technology's passed them by.
Yeah.
And so what we want to do is be the people who can arrive with expertise that's proven, solutions that are proven, but at the same time be able to take advantage of some more contemporary technologies at the same time, so that there's a reasonable mix of risk for our clients.
So describe your typical company or the range of companies that would be using your services.
So we've worked across a wide variety of industries and a wide variety of client sizes. But what it comes down to is that we focus on the project inside of the company. We've worked with some startups that have gone through their own MVP cycle and are looking to move to a version 1.0, and they've brought in 10 people, even though they were a small company. We've worked with very large companies that are looking for very niche specific skills, and they only work with us in 1 or 2 to 3 people in that area. So it really depends on the value of the project and the need.
So if someone wanted to get a hold of you, how would they do that?
Well, the best way is to look at our website, www.itrellis.com, and connect with us there. You can also send an email to info@itrellis.com.
So give us the information again on the website.
It's www.itrellis.com.
Okay. So I hope you hear from a lot of people. I think we've just explained what you do.
All right. Thank you very much.
Makes very good sense.
Thank you.
We're coming to a commercial break. Don't go away. I want to talk about some of the myths of the stock market. Be right back after this break.
Stay tuned. About Money returns in a moment with Mike Adams here on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
How do you picture retirement? House on the beach, small farm in the country, traveling the world with your spouse. The one thing you don't picture is running out of money. Retirement dreams are shattered all too often by poor investment choices, sending many retirees back to work. If you think the job market is tough now, try entering it after you've retired. Don't run out of money. Start planning now. Call Mike Adams of Adams Financial Concepts today at 206-903-1019 and learn more about how you can create wealth for retirement and probably, most importantly, protect yourself from running out of money. Adams Financial Concepts specializes in creating and maintaining wealth. Call today, 206-903-1019 or log on to adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.
About Money continues. Remember the website adamsfinancialconcepts.com. Here's Mike.
Happy to be back again. We want to talk about some of the myths in the stock market. You know, it's the time of Santa Claus. Santa Claus doesn't really exist. You know that. But the presents arrive on Christmas Day or whatever time that is normal. You know, the same kind of things go on in the stock market, the same kind of myths. You probably know, and I put "no" in quotes, that the more volatility a stock has, the more risk is in that stock. The more volatile an investment is, the greater the risk. Do you believe that? Well, in some respects that's true, but in sometimes it's not. Commonly, more volatility equals more risk, especially with what we went through with the Great Recession. The stocks went way down. That seemed to be more risk. But you know what? The belief is that a T-bill portfolio is going to be much safer. It's more conservative. It's much better to have, if you're looking for the least risk, to have a T-bill portfolio than a stock portfolio. But it really depends upon the type of risk. Certainly, T-bill portfolios have less credit risk, the risk of losing everything. But if you look at the time horizon, you have a much greater risk in a T-bill portfolio than you do with a stock portfolio. Think about this a second. Take two portfolios. Both start at $100,000 and both are handled for 25 years. And you take the least volatile, the one that is considered the most safe, the T-bill portfolio. You put $100,000 into T-bills, you roll it over every 90 days as you do. You know, T-bills running 1% today, they'll 1.25%. They'll get up to an average of around 3% at most times. And in 25 years, that portfolio will have generated $122,130 at 3%. You'll have started with $100,000, add the 122, your portfolio is now worth $222,130. But if you look at the stock market and you look at a return of, say, 9%, which I believe could be low, but 9% over a long period of time is probably about right. Some years it could be down 20% or 30% or even 37% like it was in 2008. But if the average is 9% over those 25 years, the portfolio ends up at $862,310. Think about that. What's the safer, least risky portfolio? The one that gets you $222,000 or the one that gets you $862,000? Now, if you're talking about needing the money in 6 months or a year, for sure, the T-bill portfolio is going to have less volatility and you're going to be more sure of getting your money back in 6 months or a year. But if your time horizon is longer, like 25 years, as most people time horizon is, a stock portfolio is going to be really a lot less risky. And if you add in the rate of inflation, that T-bill portfolio will be about $100,000 in 25 years from now dollars. You're not going to have gained much at all. You know, Robert Markham wrote a book called Hazardous to Your Wealth, Extraordinary Popular Delusions and the Madness of Mutual Fund Experts, taking off on the book that I mentioned earlier. And he quotes, there's a quote I like, a couple quotes I like. The book takes a skeptical look at what until now has been the commonly accepted way of things in the mutual fund world. You'll see that much of what financial planners, the media, and advisors and mutual fund companies have told you is simply not true. It's a bizarre, almost Alice in Wonderland type of story. You know, the idea of reducing risk over a long time period is not really reducing risk. It's not really true. You know, the idea is to understand what you're investing in and why you're investing in. There's a second myth that exists, and that's that small stocks outperform large cap stocks. There were studies that were done. A study that was done, the original research was done by Rolf Banz back in the 1970s, and he updated it through 1996, and he found that from 1926 to 1970s, that small cap stocks outperformed large cap stocks. They did much better. Take a small cap stock and it grew much faster than a large cap. The fact is, if you look at what happened, 1926, what happened? 1929, 1931, 1934. During that Great Depression, what happened to large cap stocks? They became small cap stocks. And so when you look at what happens, when those companies recovered, they became large caps again. Their growth rate increased significantly. So if you just look at it as a small cap growing into a big cap, you started with big cap that became small cap. You saw the same thing in the Great Recession where stock prices came down. The Dow came down to 6,600. Today it's at 24,000. Some of those large cap stocks in 2007 drifted down in value to become mid cap or small cap stocks. And now today they're back to being large caps. The second time when you look at it was 1941 to 1945 when we again had a downturn where a number of large cap stocks became small cap stocks and the blue chip stocks which had become small cap outperformed. So when you say small caps outperform large caps, it all comes down to looking at the data. So many times in my field, in this financial services business, in the investment business, there's a myth that's generated. 4% is the most you can take out of an investment portfolio. Today, the belief is that you have to invest 10% in your 401k to have enough to retire. There are so many ideas and things that are sold as gospel, as truth, as you have to believe this. But it's not really true. You have to look at the big picture. And that's what part of this program is about, to keep you, the investor, understanding what the real risk is, where the real returns are, to put you ahead of the curve instead of behind the curve, to make you a better investor so that you can achieve much better results. Coming to the end of the program today, so have a very good weekend and a very good preparation for the holidays. You know, a couple weeks ago we did a program on White Christmas. I would sincerely hope that this is not going to be a White Christmas in Seattle, but that we do have very good holiday season. If you miss any of this program, you can find it on YouTube, and we're about to release our new website. I talked about the website before and the problems we've had with hackers on the website. In the next couple of weeks, we'll have the website up. Then is a time to go look at adamsfinancialconcepts.com. Until next week, I will be trying to generate excellent returns. You too.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you want Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared on the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again for more About Money with Mike Adams here on Business Radio 1300 KKOL.
The preceding program was sponsored by Adams Financial Concepts. Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.